Good evening, ladies and gentlemen. Welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Now, today I want to talk about investing in the stock market, but more specifically, active or passive investing. Now, I'm going to explain to you what these two terms are, but I want you guys to have a think about investing and whether you want to be an active or passive investor, and we'll go through what both of those are today. So stick with me and let's go. Alright, so if you guys saw one of my last videos, I talked about index funds, okay? Where you buy shares in a certain index, one index that's traded under one symbol on the stock exchange, and that index invests in a wide variety of companies. Now, they can follow different metrics like we talked about. There's the VAS, which is the Australian share market, IVV, which is the S&P 500 over in America, or IOO, which is the top 100 global companies. Okay, so we're going to start with that idea for what is passive investing. Now, passive investing means investing almost all of your money in index funds, and you have to do it passively. So that means putting money in when the stock market is crashing and putting money in when the stock market is booming. Now, if you invest passively, you might pick one index or maybe even two and just put all your money you've allocated for investments into those indexes. And over time, because you're putting your money into a whole range of companies, either whether it's the 300 companies in the Australian Stock Exchange, the 500 top companies in America, or the 100 top companies in the world, your money is being split between, a huge variety of companies, and that will almost certainly guarantee you a long-term return. Now, that's the key. It's over a long term. So if you choose to do passive investing as your style, you can expect a rate of return between probably 7 and 11%. But that's only over a very long period of time, say 10 years or even 20 years, because that's how much most indexes average over that time. Now, that includes huge stock market crashes like the GFC, and it includes huge bull runs or booms in the stock market like we've been having for the last 10 years, particularly in America. Now, it's called passive investing because you really don't have to do a lot of work. Once you've picked your index, all you do is put money in there and watch it slowly compound over time. Now, this is a fantastic way to get a really healthy return without having to go through any effort at all. But this is the key. You have to have a really long-term view about it. Because if you put your money into an index and then get scared when the share market crashes and you take all your money out, you will almost certainly end up worse off, okay? Now, real investors, they look at when the share market crashes, they see it as an opportunity, not a tragedy, because all those companies that you've been putting money in are suddenly on sale. And you'll find that the index, even though it goes down, that means that all the companies, the top 300 or 100 or 500 companies are all really cheap, okay? It's like a supermarket having a sale. So that's really the key with passive investing. You've got to invest constantly, consistently, no matter what the market's doing, you should be investing. Now, that's called dollar cost averaging. When you put money in when the share market's going down and you put money in when the share market's going up. That is the best way to guarantee that long-term 7 to 11% return. And the best thing about it is anyone can do it. It's really, really easy. All you do is put your money in those funds and watch it compound over time. Now, let's talk about active investing. So active investing is really defined as anything that's not passive investing. So if you're only putting your money in index funds, you're passive investing. But if you're buying shares of individual companies, Telstra, Facebook, Google, you're what's called an active investor. You're actually picking companies that you like. Now, the problem with active investing is over a long period of time, most people don't end up beating the market. They don't end up beating that 7 to 11% return. And that even includes professional investors, people who run super funds, people who run managed funds, mutual funds. A lot of them, like a substantial amount, a startling amount, do not beat that 7 to 11% return over a long period of time. And that definitely includes what we call retail investors, average investors like me, who want to try their hand at stock market investing. Okay? So that's the thing you've really got to invest. And a lot of people who invest kind of do a half and half approach. They might put half their money in an index fund and then try and beat the market with that other half. Because at least you're getting that guaranteed market return. So if you are thinking about investing, I really want you to think about what type of investor you want to be. Because if you want to be an active investor, you've got to do the work. You've got to have a look at companies that you want to buy. You've got to go through their financial statements. You've got to understand what they're doing. You've got to have a look at how they make their money and whether you think they're going to make their money at a higher rate than what the market can give you. And only then, after you've found a cheap price for a company you really like, maybe you should buy some shares in it. But if that sounds a bit scary, if that sounds a bit complicated, maybe you don't think you have enough time to sort of do an active portfolio, I highly recommend that you just go with a passive investing style, because you're still guaranteed that rate of return that the market will provide. And over the last 50, 100 years, most index funds that just follow one index in a country get that rate of return, that 7 to 10 to 11% rate of return, which is far, far better than you will get putting your money in a savings account at the bank, even a term deposit at the bank. I think the term deposit rate, you'd be lucky to get 3%. And I mean, you know, how does that compare to the 7 to 11% return? I mean, it's just crazy. And another note with passive investing, if you get that 10% return, your money will actually double every 7 years. Now, I know that sounds like a long time, but if you're constantly putting money in that dollar cost averaging way that I talked about earlier, if you're constantly putting that money in over, say, you know, maybe you're 25 and you do it for 25 years, you know, that's a lot of doubles in that time. 740, that's almost 3 doubles. You know, that's a lot of money, and that's money working for you when you don't have to do anything about it. All you have to do is make small regular contributions. All right, so the main message I want to sort of leave you guys with tonight is, if you're thinking about investing in the stock market in an active way, that's great. But you know, there's a lot of work that goes into it. There's a lot of things you've got to research. You've got to put a lot of time into it. If you don't think that's for you, I think passive investing is a far better way, or at least maybe a split, you know, split your money between an index fund and maybe playing around with some shares. But the thing I want you to take away from this is that most people do not even beat the market, okay? Even Warren Buffett, I think, averages a rate of return of about 20% over his whole career. So he's doubled the market average. But I mean, that's the greatest investor in the world that's ever lived. And he's doubled the market, you know? If you don't think you've got what it takes to beat the market, then I strongly recommend passive investing. Alright guys, thanks for watching. If you like this video, hit the like button, hit the subscribe button. So thank you for watching. I'll be back soon with some more videos. But for now, good night.